How do you turn 2 million into 2 billion? Well, you do what this guy did.
Finding a tenant, it's a new facelift on the property, isn't it? And
Yeah.
it gives you an opportunity to get the valuer down and revalue as soon as you've got that new lease. And that's kind of the most exciting bit for me these days.
If you've given someone 3 months to go and find you a tenant, if they can't do it in 3 months, you need to change. You shouldn't be scared of debt. If it's serviceable, that's the only way you're going to grow.
A lot of people think, oh, I'm spending more, you're going to up the risk. You're actually lowering the risk because you've got the bigger businesses behind it, the longer leases, blue chip locations, which means they release quicker.
That's
so
right.
Spending more in commercial is actually a way of lowering risk.
So are you going to be that person that sets up your kids and their kids? You should be, because that's what drives me. Are you going to be that grandfather, right, who's got the picture on the wall and they go, he started all this, right? That gives me goosebumps, that stuff.
Welcome back to Inside Commercial Property. I'm Scott O'Neill, and today we're diving into part 2 of our conversation with Daniel O'Brien from X Commercial. So Dan, one of the questions that I'm getting asked more and more is when to buy and when to sell. And obviously I'm an investor, we help people buy. So we're obviously skewed towards like long-term ownership.
Yep.
And you're the opposite, you actually help people sell.
Yep.
So how do you, I guess my question is, when's a good time to sell, especially when it's a blue chip asset and there's potentially more growth on the horizon? How do you make that call with your clients?
It's really individual. So individual to the asset and also individual to the owner and their motivation and their journey or their progress in life. So I know that's kind of a really broad answer. I guess another answer would be, and this maybe is, you should really, if it's property and blue chip, you should probably never sell it if you don't need to.
So you tell you buy?
Yeah. Yeah, some. Yep. There will always be people who need to sell though. But if you've got a blue chip asset and it's commercial, try and hang on to it. I know that cuts across what I do as a selling agent, but really, if you're looking after your clients, sometimes they'll come to you and you say, you should hang on to this one. You should sell the other one, right? So if they go to you with a basket of properties and you might say, yeah, hold this one, but the other two you could probably let go of. Identifying the optimal market conditions. First thing is you are never going to pick the top or the bottom of any market. If you get within 5 or 10%, you're a genius. You need to look at macroeconomic factors like you would rates, what the economy is doing, business confidence, all of that, but you need to overlay that with your particular asset. Now, you might have extended a lease for 10 years. That's a good time to sell. Right? You might be coming up with a 2-year whale or tail lease expiry. That's not a good time to sell. So the other answer to that is it's a good time to sell when you've extracted as much value as you possibly can.
That's where you see all these auctions. They've got those perfect, 15-year childcare leases or the medical center on a 10-year. You're going to maximize your price.
That's right.
Generally like 20% up compared to a lower lease.
Correct. And the reason because investors have certainty and they know it's a 10-year thing and investors love certainty.
And what percentage of your clients would actually be investors selling versus owner occupiers?
That's a great question. And that changes with interest rate cycles.
Of course.
So when the rates are at a level, there will be investors playing and owner occupiers will be out of the market. And then when rates change, it will make sense for owner occupiers to purchase rather than rent because the rates are that low. And this has happened in the last probably 4 years. Occupiers have gone, well, I may as well buy something because it's cheaper than actually renting it.
I've noticed one thing with my investors, a lot of them are selling down their cheaper assets because obviously you grow into your portfolio in time. You start small.
Yep.
Smaller ones tend to have a little bit more risk associated with them and a bit more turnover with tenants. But if you can then, benefit from capital growth for a few years and maybe sell 1 or 2 or 3 of them, maybe a resi on the side, you can pool the money together and then go into those blue chip investments you mentioned.
In that case, that's a great time to sell.
Yeah.
Right? Because you're leveling up. And you're pulling the equity out to get a bigger, better portfolio. Yeah. So yeah,
and that's something I've been kind of dealing with my portfolio for the last few years because when I started, you're investing 100 grand deposits and you don't really get too much for that. But you pull them together and you can start you're actually de-risking by going larger. A lot of people think, oh, I'm spending more, you're going to up the risk. You're actually lowering the risk because you've got the bigger businesses behind it, the longer leases, blue chip locations, which means they release quicker.
That's
so,
right.
Spending more in commercial is actually a way of lowering risk.
That's right. Yeah.
When you sort of talk to your investors or owner occupiers, do you get involved in helping them calculate or show them opportunity costs of selling or the opportunity of selling and buying something higher yielding? Do you ever go into that level of detail?
I do. Okay. Yeah, I do. It's not often though, because a lot of the people we deal with, they know this already. They don't need to be educated.
Yep.
So for the smaller end, yeah, you do need to hold a lot of hands, but 5-10 million plus, they're switched on.
Yeah.
I learn from them.
And just for the benefit of the listeners, I'll just go through really quickly how I look at sort of return on investment or return on equity. So we run spreadsheets at Rethink, and it's really just calculating the return from a cash flow sense off your deposit invested. So if you're investing, most of our guys are using leverage. I think it's smart to use leverage. So $2 million loan, if you leverage into that, you're going to be taking a $1.4 million loan at a 70% mortgage. Stamp duty and all those costs go into it. You're probably going to be in the hole for about $700,000 to invest, but you're getting $140,000 or $135,000 rather. That's your 7% return on that $2 million. So then you got to take your mortgage out. So if you've got an interest rate of say 6%, your interest paid is going to be 84. So 135 minus 84, you're left over with $51,000 passive income. So remember, the return on equity. So we invested $700,000. So it's simply 51 divided by $700,000, and you're going to get a return on equity, pure cash flow of 7.24%. So that's how I look at my portfolio. And you could imagine every year it gets better because your rental increases hit. So if there's a 4% increase, you're going to get an 8% return next year on equity, then 9.29. Fast forward that to year 10, you're going to be around 25% pure cash flow alone. But then there's the capital growth on top. So you got to then, plug that into it, whether it's 5, 7, 8%, whatever the growth rate. But it's always important to go back to those return on equity equations, because when you get too much debt on a property, it's going to have a negative cash flow sense. So that's one pillar to look at.
Yep.
And the other one is make sure you're actually maximizing your position, just like you would with a stock portfolio, because you wouldn't want to be sitting on a negatively geared property that's even if there's not much debt on it, maybe you could pull some out and maximize it somewhere else. But this is how this big generation of investors is looking. And you can really build great portfolios if you play debt smartly and get the yield that, covers the debt. And
that's right.
So that's something that's we're seeing with our clients as well.
And I think spelling that out and showing it on a spreadsheet that's really clear, that should get people excited.
Yeah. Well, where else do you get those types of returns? And this is not investing in specky shares, which with a company that's been around for a few years. Like, this is bricks and mortar, and a lot of the time you're just buying the same tenant that's been there for 20 odd years. It's nice knowing what's going to happen because it's been happening.
Yep.
And like, you've got COVID to look back at, see how they performed in that time. And COVID kind of cleaned out a lot of the, weaker tenants as well. What do they call them? Zombie businesses?
Zombie businesses,
like
yeah.
So there's not too much of that going, but we've got new problems now, inflation and cost of living and all that. So
that's true.
That's the stuff we've got to look through. But a lot of these guys or guys and girls are fairly old school investors that have held properties for decades, haven't they? Are they even using debt like we do? You know? So it's literally cash.
Oh, look, I think they would, because it makes sense.
Yeah.
Like I said, all these people are smarter than me, so I'm sure they are using debt.
Yeah. Because
you shouldn't be scared of debt. If it's serviceable, that's the only way you're going to grow. Like proper. If you want to be serious about growth, you've got to use the bank's money to grow. Now, anyone listening to this podcast is interested in commercial property. Otherwise, you wouldn't be tuning in. So I think you've got to use the bank's money to help you. And I'm doing it myself.
Well, it's a way of, like, I always use the analogy, if someone gave you 100 million cash today, you'd go buy 200 million of commercial property. Just go get a bank loan, lease stock loan. Mm-hmm. You got twice the property, more diversification. There's a bit of debt in there, but you're covering the debt with the yields and the net cash flow from the property. So
that'd be a lovely problem to have.
Why not? Yeah. And all the big fund managers do this, like, so do all the biggest companies in the world. Debt is part of the business model.
Apple uses debt.
Exactly.
They've got trillions in the bank and they use debt.
Yeah.
So, it's the way to do it.
Yeah, and that's why I always find it interesting, because we'd buy a lot from, your likely clients,
Mm.
and they've just got no debt, huge portfolios. But yeah, it's a whole different world that, you only really get a snippet into.
Some of those guys, right? Some of those guys, their grandfathers started.
Yeah.
Okay. So it's inspirational to look at them and go, wow, you get out of bed every day and you're earning $30 million in rent from your investments, right?
Yeah.
But sometimes that's 2 or 3 generations down.
Yeah.
So are you going to be that person that sets up your kids and their kids? You should be, because that's what drives me.
Yeah.
Are you going to be that grandfather, right, who's got the picture on the wall when they go, he started all this, right? That gives me goosebumps, that stuff.
Yeah, yeah.
Right? And a lot of people listening to this, I'm sure, have ambition to do that. And that should drive you,
100%.
because once you're gone, obviously you're gone. But if you can leave that for your kids and their kids, that's my goal. That's what drives me.
Oh, and especially the world we're going into now, like imagine the advantage that gives someone, like even if it's only one little property that you can hand to them.
That's the thing though.
That's a life changer.
Do one, but even if you do one every 5 years, you're going to have 4 in 20 years time.
Yeah.
Or 5 in 20 years, ambas on maths. Yeah. But just start.
Yeah.
And don't be scared of it. And using someone like you, Scott, you hold their hands the whole way through. You start with a little industrial strata unit somewhere and you just work your way up.
On that note, do you have any kind of case studies where you've seen someone start small and get to quite a large portfolio? No, maybe not the position of family office, but yeah, because you've been heavily in this industry for 20 plus years. So surely you would have seen some of these trajectories from the start.
Yeah, lots of them. The best one is a young bloke, and he's still young, but he's just got a DA for I think it's a 50,000 metre office tower in the city here. Right. And he started with buying an asset for $2 million. That's now, he's got probably $2 billion worth of development in the pipeline.
Wow.
And he's just turned 40.
Wow.
Right.
And he's a full-time developer.
Yeah.
Yeah.
Full-time developer.
Yeah.
And how do you turn 2 million into 2 billion? Well, you do what this guy did. And he went and optioned up little sites, little residential sites, 8 apartments, got the DA, got an extended settlement, flicked it to a developer builder. His return on equity was a 200 grand investment to get the option. He had it for 2 years, recycled out, sold it for 4, took his 4 mil, turned 200 grand into 4 mil, bang, win again.
Happy days.
Yeah. Then he put 2 million into 2 assets, and then he got 10 or 15 for each one. So pull that out, go again.
Wow.
And, he is one of the unsung well, not unsung. If you're in commercial property, you know who he is. But he's an exceptional, human being.
Yeah.
And he's just done it and leveraged up.
What is the development game like now? Like, I've got my opinion on it, which, but I'm keen to, because you're dealing with these guys every day as well.
Yeah.
Like, how is it now for these guys?
It's really tough. Construction has skyrocketed. It's coming back, but it's still prohibitive.
Yeah.
And the problem is getting a DA. Like the government now has put those templates out by saying, if you build this, we'll fast track any development. And that's good. That's a start. But the local councils is where we need help because they're not very conducive to development, and that needs to change quickly.
Yeah, well, we're just undersupplied everywhere, isn't it?
We are.
Except CBD office.
Except CBD office. And there's a lot of investors that have got money that are happy to invest in resi, but also are happy to do mezz funding, or like guys like Stanford have got a lot of money to give resi developers to get them going. The resi developers just need sites to work.
Yeah.
And that's the problem at the moment. Sites don't work. Land price is really high. And, unless you're building a boutique development in the East or North Sydney that you're going to cater to grandparents, right? 4-bedroom flats that are got lifts in them, that they're going to cash out their equity, sell their huge place at Clifton Gardens for 30 mil, and they're going to buy an apartment for 15. That market's going well, but everyone else is tough.
Yeah, I think it's one of our number one sources of new clients, developers not developing. So this is all over the country.
Exactly.
They have, normally like they've just sold out of a project. The last project didn't go too well. And they're thinking, well, what do I do with my money? And we're collecting a lot of these leads because they just want to go park it into a shopping center for 10 mil or 15 mil, and you'll get your 7% return or 6.5 plus growth. Plus, there might be a bit of land you could tinker around with later as well. But
Yep.
I've really noticed that in the last 2 years.
And development margins, when developers look at these things, it's 20 to 25%. But that's a 3-year process, and they've got to put up their house. They've got to put up so much security. It's really prohibitive. Why would they not go and buy something that's pumping out 7 or 8% and they don't have to worry about it?
Well, on that note, like if you're using that kind of calculations I was doing before, if you've got a 70% mortgage on a property, you're getting a 7% return and you get 5% growth, you're actually going to get 21.5% return on equity year one. That's with the 5%. Remember, because you're only using 30% cash and banks doing the rest. So imagine that over 3 years. Like it shoots the lights out of most projects.
Yeah.
But then you're not selling. You've actually got a good asset you can hold. And that's the bit I like the best. This is why I personally never went heavy into development, because I want to own these things and let it compound. Because the magic happens after year 5 of ownership. Any good, like even a bad deal looks good after 5 years, generally.
That's right.
Your debt's kind of inflated away a bit. Your rent's gone up for 5 years in a row. Prices, land values, building costs. All of a sudden, you look like you got a good deal.
Yep.
Even if you didn't. So, yeah, no, buying and hold's always been my preferred. But yeah, I've never understood the development margin scenario. Obviously, like your client you mentioned, that's they're unicorns and they play games that many others couldn't. But yeah, it's fascinating to know how you could want to go build a duplex for 10% margin and risk it all.
The amount of duplex developers I've had reach out over the last 12 months saying, what you do, I don't understand it. And I'm like, it's if you buy an industrial asset and you can repurpose that to office, that's the gold, right? And that's happening a lot in Sydney, and has happened a lot in Sydney, and it will only continue. So changing the use of a property doubles your rent, therefore doubles your asset growth. So in areas of Sydney, you can definitely still do that. And I think as people follow the infrastructure and the metro and train lines, look for that.
Is it mostly just industrial converting to higher use? Retail?
No, office.
Resi?
Office.
Interesting. Yeah. Alexandria and whatnot.
That's full of it.
What would be the difference in rent for a standard warehouse to a standard office?
Double.
Yeah, there you go.
Yeah. But you can find those opportunities now. So Surrey Hills 15 years ago, that's what was happening. Then 5 to 10 years ago, that crawled out to Alexandria. Now if you just draw a ring around the city as a radius and just push it out 5Ks, that's where you should be looking now. You should be looking for those industrial assets now that you can repurpose. But even a lot of them are old and tired. So we've had a lot of success, or our buyers have had a lot of success buying something that's come up. An investor might have held it. The tenants come out of there. They might be vacant for 3 or 6 months, or 3 months probably. Then we sell it to a new guy who comes in, puts all new LED lights in, new roller shutters, new paving, and they might have paid, $5,000 a meter for it, and they're going to sell it for $7,500 a meter. By just hosing it out, giving it a paint, doing these little cosmetic things. And if you do that over 1,500 meters or 2,000 meters, there's money in that.
100%.
And
you're seeing a bit of I know those quasi type offices, they're having a bit of a rebound, aren't they? Slowly. Because they're just.
Do you mean the office warehouse type?
Yeah, I've seen a lot more. Because we were looking for an office for a while, and the ones I like the look of were those ones more than the things in the towers. So
because they're creative. They're not going to high ceilings. They've got exposed ductwork. They look nice. It's that New York meat packing area type. When you picture that in your mind, they're the things that sell really well. Really well. So Scott, what's a common mistake you see when investors are deciding whether to sell or not, and how do they avoid that most common mistake?
Well, look, in our circles, it's pretty rare. Like the only times I've seen owners want to sell is just when something goes wrong. So like, let's say a tenant's saying, we're vacating at the end of our lease. They're like, oh shit, let's sell. Like that's the work. Like that's when you want to buy. Like you were saying before, it's like the price is going to be at its lowest point. Sell, if you're going to sell when the lease is 10 years and, maybe you want to upsize into bigger deals or whatnot. But we've seen just a few of those occasions when there might be a big building and pest issue, or like that's when you don't sell. You just got to kind of, knuckle down and fix the problem at that point, which is hard because it can be a little bit disheartening, as you could imagine. And it tends to be at the most entry-level prices as well, because again, the higher you go up the value spectrum, the more experienced the investors typically are. So they don't have those kind of freak out moments as well. Like I've personally had many of them, but it was in my resi days, when, a tenant lit something on fire, or there was a big mess there, or the third tenant left quickly. Like those things are kind of what you grow up and learn about investing, and it hardens your skin, thickens your skin rather. So, but that's what happens when a first time commercial investor comes in, something goes wrong with a tenant, they look to sell at that point. And sometimes it does make sense. Like, as you know,
just about to say that
the vacant warehouse market sells at a premium because owner occupiers are ready to pay more than investors due to the yield and the current interest rate scenario. But that'll fluctuate over the decades. But so in that case, we've had a few investors sell at massive premiums.
Correct.
And they'll call me, and it's just like you plug it into a spreadsheet. You go, well, are you going to get more as a vacant property or more if you tenant it? If it's more as a tenant, just fill it. Like, it might take 6 months. You might have to get incentives. You might just need the market to improve or get away from the Christmas bubble and that's things like that to give you some more inquiries. But it's always that kind of when something negative happens, people want to sell.
And it's very specific to the property and like the lease tail. Like I've had investors, when things have become vacant, I'm like, now's a good time to sell this because what you would get as an investment is 2/3 of what you would get if you sold it to an owner occupier.
Wow.
And in that case, it's worth selling.
So it's that much of a differential in your markets?
Yeah, definitely.
Wow.
Yep.
30, yeah.
Office and industrial, yes.
So office, sells for a premium?
Yep.
Really?
Yep.
Interesting. Because the investors are scared of the outlook, and there you go.
True.
What about retail? Seeing any difference there?
I haven't, no.
It could be a higher percentage of investors, wouldn't it? Because a lot of the retail type tenants are institutions that don't hold property.
That's what I was kind of meaning. I should have explained. Yeah. When I say no, I mean investors love retail, but retail are mainly tenants.
Yeah.
They are genuinely tenants normally.
Yeah.
Unless you're like the Harvey Norman and those guys who've got their own portfolios. But yeah.
And a lot of people go, why don't they buy? And it's, you've probably got your own spin on it, but as a business, you've got like an active income versus passive income. There's obviously more risk for business. So they might be getting a 30% return on their equity versus, what we're talking about, 7+ growth, which might give you 20.
That's right. I think for retailers, they need to look at where they're going, and they would rather probably have 5 or 6 stores that are trading and getting profitability there rather than being landowners.
Yeah.
So it's all about the motivation of the occupier and the buyer. And I think for businesses, I think they can make a lot more, or they know they can make a whole lot more than a 7 or 8% what they're going to get as an owner. That's why they don't mind leasing.
Yeah.
Because you times that over 5 or 10 stores or 20 stores, that's much better strategy for them than becoming owners.
And the famous examples are like your Bunnings, KFC, Hungry Jack's, like, imagine all that capital sitting on a balance sheet.
Yeah. Well, that's why Woolworths and Coles don't really own. They lease.
Yeah. No, it makes perfect sense. And that's why, like, these companies, they need investors, obviously they say, people don't need commercial, like a roof over your head, like in residential, but these businesses do, because without it, there'd be just a lot less productivity in the, ecosystem out there, and it just wouldn't stack up. So they wouldn't exist.
Yeah, true.
So they need investors at the end of the day. Like we had a really big result. It was an investor who bought a property a couple of years ago in Perth, industrial. It was a bit of a showroom type thing, 1.7 mil. And he just sold it for under 3 mil vacant to an owner occ. And he was having trouble kind of filling it because it was larger enough side, or I don't know. There was just, the tenant pool wasn't there at that period he was looking.
Sure.
So it's not a value add, but it's a massive value increase for doing absolutely nothing other than losing his tenant. So he took the win. He took the win, and he's using that money. He sold another property, and he's now looking at a 4.5 to 5 mil asset, which is a really good result, because the difference in quality, like you can pick up a mini shopping center in that range, or a pretty decent, maybe not in Sydney, but
Perth you could.
Perth, outskirts of Brisbane, all the majors, like even Melbourne's pretty cheap these days. But a great example of just selling, massive profit, short time. He's got to pay capital gains tax and all that stuff with it. But the end result is he's upscaled into a much better property, which he'll keep forever.
Mm.
And like little examples like that are everywhere. Like some of my most fond client moments are just the guys that bought those sub-$1 million little warehouses in Brisbane and Adelaide and even Sydney like 5-6 years ago. And they've all doubled in value, and they're either selling or refinancing, going into their next range. And like it's changed their lives. That's why it's kind of the most exciting part for me, because these are middle income earners that are now dealing with 7-figure profits.
Yeah, that's cool.
Like you don't see that often. And I hadn't seen it in the resi, unless you bought 20 plus properties, but then you got cash flow issues. But yeah, they're probably some of the proudest moments I've seen. And they didn't really do any value add strategies other than pump the rent up or match the rent to the market and things like that. But
yeah, you don't have to be a genius, do you?
No, stay in the market, hold long enough, good things tend to happen. And
the profit's in the buying, good deals all what you can get for it.
And like one of the reasons I love having you on this podcast is you've got the other side of town dealing with it. Like, what are the value add strategy? You mentioned last time that crack of that Woolworths deal where, what was he? Bought it for a couple of million.
Bought it for 3.5 and it was worth 22. I've actually got a better one.
Yeah.
Which is $40 million in 6 months. It was on the market and he bought a site that was 5 lots and he paid 22 mil for it. And then he sold each lot off. I sold each lot off for him within a month of him settling. And then he had a building in the middle for free. So he bought it for 22. We sold 4 of the 5 for 29 mil. So he made 7 mil. And with the 7 mil, the building in the middle, he renovated and then leased out to a fashion company for 10 years. That was $2 million a year in rent. So at 5%, that's a $40 million asset.
It's crazy.
That he got for free.
Wow.
Now, the thing was, I was telling everyone when I was selling this building, selling this site, here's a plan. I think you should do this. And people looked at me and went, oh, that'll never work, or this is an agent trying to spin me a line or whatever. And the guy who bought it had done work with me before. And I've given him some tips before and he's like, yep, let's do it, Dan. Let's absolutely do it. And he did. And it was $40 million and it was about 6 months, 6 or 8 months. And that's just a great deal.
Oh, yeah.
But everyone else had the opportunity to do it because I walked 60 buyers through that site and I told all of them that plan. And they all looked at me and thought, mate, you're mad. It can't be that easy. And it happened.
That's fascinating. Well, like how many years ago was this? Fairly recent?
2015, so 10 years ago.
Yeah, so not long.
No, not long ago at all.
What are you seeing in the current market? Like, obviously they're outliers, but yeah, is there still opportunities to make money like that?
There are. Like I've been doing this 20 years. I've got 3 really good stories like that over 20 years. Yeah, so they don't happen all the time.
They're unicorns, yeah.
Yeah, they are, but they do happen.
Yeah.
But we've got plenty of other stories where people made 1 or 2 million in 1 or 2 years by listening to the advice we gave them. And I've got a building in Western Sydney now that spoke to the team this morning, right? It's vacant, but we've got a tenant to go in. And if an investor buys it at what we want, 12 mil, it'll be worth 15 as soon as we do this lease. But the lease isn't going to happen next week. It's going to be a 2-month process.
Yeah.
So we can match tenants to buildings and then we can flip buyers in. And we do that probably half a dozen times a year.
I actually find that, like, even with my own personal portfolio, that's the most exciting part of ownership. Well, buying is, but then that, you're over that within, a day of it settling. And then you get a little bit frustrated when things don't happen perfectly. But finding a tenant is actually like a new lift, or it's a new facelift on the property, isn't it? And it gives you an opportunity to get the valuer down and revalue as soon as you got that new lease or sell. That's kind of the most exciting bit for me these days, looking for those tenants. But you got to deal with downtime in rent and whatnot. But, that's going to be a big part of anyone's property ownership. And my advice is, don't be down when you lose a tenant. Just problem solve, fix it, because when you do, you're probably going to get your biggest chance of a value uplift that you're ever going to get. Yep. The market will do its thing over time, but a tenant can give you a pretty big sugar hit in between.
Definitely. We just don't sell, like, I've told stories that, $30 million, $40 million assets or 12. We sell things that are 1 to 2 to 3 mil as well. So we have entry level as well. Like we've got a project in Chipping Norton. It's 40 odd industrial units. You could buy that now, wait for it to settle. We'll find you a tenant. From day one, it'll be 6% or 7% net.
This is probably more towards your property management side of the business. Like,
Yep.
Because there'd be a lot of people that have lost tenants in the last 12 months because of the inflation issue. Because business margins have squeezed.
Yeah, they have.
No way around that.
Yeah.
Wages have gone up. There's obviously that really great period after COVID's gone. Interest rates are the big killer. We're probably going into a better period, but those have lost tenants. Like, what's your advice? They've obviously got property managers looking for them. Do they just stick with them, or do they shop around, use multiple agents? Like, what's some of your advice if you can't find a tenant?
This is something that we talk about daily, and I love people who are loyal, but there comes a point where if you've given someone 3 months to go and find you a tenant, if they can't do it in 3 months, you need to change.
Yeah.
Because as agents, all we do is make money for our clients or save them money. That's it. When you boil it down to, that's all we do.
Yeah.
And if you are loyal to your agent, that's really good. But if they've had 3 months and they haven't got a result, the agent's not going to start paying your mortgage, right?
No.
So you got to change.
What if they got like an exclusive agreement? Can you
Well,
get out of
normally they're 90 days.
Yeah.
So you shouldn't be signing anything more than 90 days.
Because I've seen some agents try to push 3-year
Yeah.
examples through.
Yeah. But 90 days is enough. If the agent's doing everything they can, then you leave it with them. As long as they're doing everything they can.
Yeah.
Right. And they're reporting to you every week and they're giving you feedback and they're like, we're trying everything here. That's great. Sometimes you get a call and you don't hear from them again.
Yeah.
So yeah, be very particular about, and don't be afraid to change. I mean, we're all big boys. We all know if we haven't leased it, you're probably going to change.
Advice finding a manager. Like, let's say you're an investor, like, because I know you're in the game.
Yeah.
If you're going to go buy in Perth or a market you weren't familiar with, how would you go find, a property manager? Is it through referrals? Is it through going online, see who leases the most? Like, what are your tips there?
Yeah, I think you've got to get in 2 or 3 and you've got to interview 2 or 3 of them. If it's in a different state, you interview them over Teams.
Yep.
But you find out what they manage around the area. I mean, if you get onto the websites, you'll see who's active in that particular suburb that you've bought somewhere. And just interview the 3 most active agents.
Yeah.
Don't interview them, interview their property managers.
And another tip I've got as well, when you've got lease renewals coming up, one of my pet hates is the property manager just says, "Oh, just renew it." And they don't even look at the square meter rates. This happens way more than
Really? Okay.
I'm shocked it happens, to be honest, because it's like you're generally dealing with a junior in the team and like they might have some perception that the rent's at market, but they haven't checked it.
Yep.
And they just want to sign it over, even though there's a market review.
Mm.
And if it was industrial or even a good retail, like the rents could have shot up 20% in the last 2 years, or 3 years. So you must have a property manager that will show you comparable rents. So you just ask them, show me what the others are leasing for. They've all got the data internally. And you guys have more data than anything available online, which is
That's true.
One of the beauties, or one of the problems with the commercial world, how grey the information can be. There's nothing out there, but you can see the data through internal agencies or companies like myself, and you use that data to negotiate with the tenants.
That's
there's
right.
no emotions. You go, look, this is what your neighbour's paying. That's what across the road's paying. They're all 20% on average higher than you. Let's do you a deal, make you halfway up, in between.
Yep.
It's a lot easier to negotiate with numbers.
That's true. And if your asset manager, generally they have a leasing team, or if they don't, they should.
Yep.
So you don't want the property manager's view on life. You want the leasing guy's view on life. And if you've got to go to a different company to get that, make sure you do.
So leasing manager to property manager for the uninitiated, what's the difference?
Well, leasing agent is a guy who just does leasing, sales and leasing. So someone like me. An asset manager is the guy who collects the rent, pays the bills, makes sure manages the asset for you. And they're 2 different skill sets.
Yeah.
And they're very different types of people too.
This is one thing I've always, when I first started learning about commercial, I found interesting that you guys, sales agents, do leasing as well, because that's different from residential. You don't see the sales guys go off and put people into high-end spec houses. But what you do it basically to stay on the pulse, and obviously it's revenue, but what are the reasons you do
Well,
both?
leasing fees are attractive in commercial. In residential, it's a week's rent. I mean, who's going to bother doing that? Yeah. In commercial, it's could be hundreds of thousands of dollars. And renewal fees are, if you get a renewal fee, that's half a leasing fee, but that's 10, 20, 30. The fees are bigger.
Yeah.
So that's why we do both.
So what would the typical fee be for $100,000 rent? You know, so
A renewal would be 6,000
Yep.
to keep an existing tenant and get them on a new 5-year lease.
Yep.
And a brand new tenant would be 13%.
13% of the
13 grand. Yeah.
Yeah. Okay. And that's for the whole 5-year lease. Yeah.
Yep.
I understand.
Yep.
Yeah, which is not bad when you think about it, because, you know, you've just scored a 5-year lease, the value's shot up on your property, you know.
Yep.
The cost of doing business. And you're collecting bonds and stuff off the tenant as well from a cash flow point of view.
Like I'll give you a great example. We picked up a management portfolio that was managed by the owner, and he didn't charge a tenant outgoings for 5 years. That was $1.2 million. He didn't charge a tenant. Now it's a big tenant. Now we looked at, as soon as we got appointed on that, we said, why haven't you charged him this for 1.2 mil? And he goes, I didn't know. I missed it. I'm like, yeah, you bit. So we took it over. We've written to the tenant. That bill has just been paid. So our management fees, that's a big one, right? That whole estate's 8 hectares in Sydney, so it's huge. And he was doing it himself, and good on him. But you miss one thing like that, 1.2 mil. So yeah, that's 4 years worth of property management fees.
Yeah, crazy. Yeah,
so
it's a full-time job. I don't.
Yeah, employ an expert.
Yeah.
Scott, in your experience, are there any financial pitfalls that investors need to look out for once they've settled on commercial properties?
Generally, you can do a lot of your homework you have to do your homework via the due diligence process. So you start by doing the usual stuff, building and pest reports. You can look into the age of air cons and stuff like that. Previous financials could be provided by the vendor to see what they've been spending money on.
Yep.
Because the big ones we run into all the time is insurance is blown out 30% on a gross lease. So, and the agents are using, or the owners are supplying old data, and the building replacement value might be a quarter of what it really is now because they've just renewed something from a decade ago.
Yep.
This can make hundreds of thousands or millions of dollars difference. And that's probably our most common renegotiation point of view. Like when we go into a DD clause, we piss a lot of agents off because we just got the real numbers now and the yield's dropped and the owners or the buyer's not too happy. So we've got to get it back.
I'll give you that. You are extremely detailed in your DD.
I know. But it's got to a point where it's like, it causes problems with some people who don't get it because, especially like the likes of Melbourne, which is an area where they have less due diligence clause. Sydney is as well. Brisbane, Perth, no problem. But you just got to have the actual numbers because we're buying a yield. We just double check it to the nth degree. And unfortunately, it finds problems 9 times out of 10.
Well, you're protecting your client, which is your job.
Yeah. And we're starting to do things like putting a buffer in place, like say, that we assume there's going to be 10 grand or 1% error here. So maybe that's a way of kind of not blowing it up with you guys and your vendor because vendors don't care. Like I dealt with one this morning. He said, take it or leave it. I'm selling it. I can get more money because there's talk of interest rates dropping now. That was the response. So now we're sitting there going, well, do we cop it? And we're like, well, where else can we get our yield back? We can get cheaper property management. We can make, there was a very high rubbish disposal cost in there. So we're literally just shaving money, other ways with the owner's buy-in, of course, but so much back and forth just because the numbers are off. So, but yeah, what about yourself? You would have seen a few of these things.
Yeah, I think the best one was you need to audit your outgoings, and that's what you're talking about.
Yeah.
But we saved a client 50 grand a year on their outgoings from year one. So they bought a building through another agent. They came to us to manage it, which is what we love, and we looked at everything. And $52,000 a year we saved them in year one. Now it was a 6,000 square meter asset, so it was a big one.
Yeah.
So it was maybe a $35 million play, but that's straight on the bottom line.
How did you save it?
We retendered all the contracts. We objected to his land tax and saved him a lot of money there. And even things like the cleaning, just every contract. Insurance was a good one. We've got a great broker we use. I think he saved 10 grand a year just on his insurance.
Yeah.
So, they're out there, but you've got to do that. And if you don't do it in your DD, I know you guys do, but that would be the first thing that I would look at when you're looking at any asset. What can I trim up here?
Would you say most buyers do that after contract stage or before?
The good ones do it before.
Yeah.
Yep. But as long as you do it. And if you've bought something 2 or 3 years ago and you haven't audited it,
Mm.
please let us audit it for you.
Yeah.
Because there's a thing that I'm going to sound like a salesman here, but we say, if I can't save you $5,000 at least, I'll give you 10 grand.
It's a good sales pitch. Yeah. But look, you're so right. Like most property managers, like that, there's the pet hate I mentioned before, like they're not checking the market rents. And the other is, can you save on outgoings? Like, because it's like running a business. If your property manager is your GM or, operation manager, whatever you want to call them,
Yeah,
they need to be able to kind of, increase the margin on that business. And
definitely.
if they don't, then what are they doing? They're just collecting rent and charging the money on the way.
Yeah, but they're not experts in the field either. And you can't blame someone who's a CFO of a company doing so many other things, spinning so many other plates. Their properties, it's not the sexiest thing, right? So they'd probably leave it. But yeah, every investor should be doing that.
So now we're going to move on to some of our listener burning questions. So thank you for everyone putting your questions through. This is through our Instagram channels and direct emails. We've got a lot of them, so we're probably not going to get through all of them, but we'll start with a few. So Dan, question for you. What is the most effective way to increase rental yield in a commercial property? How can you reposition an asset, e.g. changing a tenancy mix or repurposing, and add value in today's market?
So I think you've got to look beyond just pumping the rents. So if you want to boost your return, you've got to create value for the tenants, and you might split the building in half and get more rent that way, because smaller tenancies get higher rates.
Yep.
You might do things like soften up the interiors of the foyer and make it more appealing to a different type of tenant. Yeah, changing the use is an easy one, right? From industrial to office.
Is there
which is
legal
happening.
Or council implications for that?
Yeah,
one?
you got to do a DA, but a lot of the zoning changes in Sydney have changed now. A lot of these enterprise zonings and the purely industrial zonings are changing.
Yeah.
So there's opportunity to do that. But in commercial, small tweaks do lead to massive paydays. So just look for that.
Yeah.
What role does sustainability and energy efficiency play now in enhancing commercial assets?
Well, look, it's becoming more and more important this day and age. It's political, it's topical, and also it actually can make the owner money, which is where we sort of go into it. So, what we're seeing the most successful thing in recent times is putting solar panel and battery storage together, working in unison on large roofs with tenants using large amounts of power. So, examples might be a large warehouse or a shopping center where they've got like deep fryers or cook, lots of aircon pumping all day. And it's all in daylight hours too, which is great. So this doesn't work with residential, but you can actually lease roofs out. We've mentioned this before on the podcast with Paul Harmsworth. And it's going to be a really big thing in the future because those power bills keep going up and there's unutilized space on roofs as well. And battery storage, how that works is it's basically just collecting power and distributing it at a more efficient rate, and that creates a margin by doing that. So it's a very smart tool, but you're going to see batteries everywhere, and it creates less reliance on the grid. So it's a win-win scenario where the tenant will get cheaper power because you're going to give it at a reduced rate versus the margins. The owner is going to benefit from leasing their roof or their back car park because they've got a battery storage facility there or EV charging. And then obviously the business has got their own margin. So it's like a three-way win. There's one person that loses in this scenario though, and that's like the big mains grid, like the AGLs of the world, because effectively you're taking market share off them because the sun creates it. And that's sort of where we're quite excited for that. So green energy, a lot of businesses need this for their marketing and obviously sustainability goals as well. So I see a big future for that side of things. Yeah,
cool. So what emerging trends in commercial property should investors consider to kind of future-proof their assets?
Yeah, good question. Look, I think the big one's diversity. I've always been a very long-term investor, so I don't invest for fads. Like I'm thinking in 30 years' time, I have no idea what's going to happen in the industrial, office, or retail market. I do for the next 5. I feel like I've got a very good pulse on that, but beyond that, it's guesswork. So if I'm investing tens of millions of dollars into investments, I'm not going to go one asset class. And it's interestingly, in the last decade, people have skewed so far towards industrial because it's it's flying. It's doing well. Rents are going up. Prices are going up. It's harder to replace and build these things at the same price. It's a good news story. But in 20 years' time, who knows? You and I, no one knows. And that's where diversity is important. So maybe go into some medical, maybe retail. Office might be back on the cards, like at full scale by then, because people are like, there's different uses for it at that time. So anyone that's a serious investor should be carefully putting their, pieces on the chessboard, spread out evenly. So hopefully you're not all in one asset class that goes bad at some time in the future.
Yeah, because they all have their own cycles, don't they? Yeah. And they always have and they always will. So
just right. And you've got a little bit of all of them. One's going down, two of them are going up. Like play the cycles, maybe residential's really good value in 10 years time. Again, get back into that heavier as a percentage, but you float around like the markets, like any good stockbroker would. You don't just keep plugging the same thing. And that's kind of why I moved my business from residential to commercial, 6-7 years ago, because I saw the numbers were just better and the growth was like, everything was looking more promising, and we've made our clients more money in this space versus residential as a result. But at some time, like you could imagine if interest rates go crazy and we've seen 50% growth from commercial, like maybe the time is not to buy now. So you got to find something else at that point, but we're not there yet. All right, Dan, there's a wealth transfer happening, baby boomers to younger generations, this transfer of wealth. We're seeing it as our parents pass away, and they're actively trying to help their kids now. Have you seen any JVs in this space? Would you recommend parents JV with their kids in commercial assets instead of helping them with a PPOR? And discuss a little bit about rent investing as well. So there's a bit in that.
Yeah, there is. I think we're seeing a shift in the sense that I have seen parents team up with kids. In the best scenarios, the parents aren't just becoming guarantors for their children, they're teaching them. The reason I'm doing this is because of this. And it's like, that's when it works very well. Getting into business or getting into investments with families, depending on, I'd never advise that. But at the moment, it's so hard for children to get a foothold in anything. The bank of mum and dad is really, we're seeing that a bit, even in commercial. Yep. So the best way to do that would be to help explain to your children and teach them why you're doing this, so they learn.
That's such a good point. Like we're seeing a lot of this at the moment where, and it's generally like wealthy families, ex big time developers, etc. But what they're doing is they get their kids involved in investing. So they invest themselves first, and then they might help with the property management, or like they're doing the books in the background, but then they're helping their kids. So obviously it's a luxury to not many, but if you're, in that position, I think it's a much better thing than buying a house, because especially if you're going to just hand them a PPOR with debt, it's like a boat anchor forever on their life to pay that big mortgage. It doesn't give them much aspiration to move or do anything other than just pay that off. But if you give them like an income and they understand it, it's like a business. It's like an MBA you've just given.
Why don't they teach this stuff at school? Like, you know what I mean? I've got children at school, right? We should be teaching them this at school. I've got a client of mine, his son works with him and they work in our building and they get on well. And this son, he'd be in his mid-20s. He's developing 20 apartments in Sydney because his dad's showing him how to do it. Yeah. And it's so good.
So that's all for today's episode of Inside Commercial Property. Thank you, Daniel O'Brien, for coming back and bringing your expert market perspective. It's been a pleasure.
Thanks for asking me.
Like always, if you want us to tackle different topics in the future episodes, please send us an email to info@rethinkinvesting.com.au. We'll definitely consider it. Thanks again.